Welcome everybody. Thank you for joining us today for our first lunchtime webinar. We normally do them mid-morning, but we thought we'd give it a try at lunchtime, see how people take to it. So joined today by Kea, as many of you will be familiar with. He's on most of our webinars, and he's been with Macalvins for some 13 years. So you've probably met him during pre-COVID times. Also, we've got Phil Stevens, who's a newcomer to the firm. Phil joins us from EY, and he's heading up our tax, and clearly has a number of years' experience in tax, both personal and corporate, as well, with a particular interest in cross-border type tax as well. So that's really, really interesting, and obviously brings a lot of experience and skills to the firm. Please make use of the Q&A tab on which will be somewhere on your screen. So I don't know if you're from a phone or a screen, a laptop, it'll be in a different place. But if you've got any questions as we go through this webinar, raise them as we go. If it's relevant to the area that we're talking about, then we'll try to address it on the fly. Alternatively, we'll pick it up towards the end. But any questions you've got, please do raise them. Appreciate them, actually. Phil and Kea love questions when it comes to tax. You have no idea. We're going to do a quick poll now to get you all started. So we're going to bring the poll up on the screen. And basically, it is what areas of tax planning cause you the most concern? So if you can just, either select one, two, or all of the above, that'd be great. I'll leave it open for about 20 seconds. Hopefully, we'll get some answers there. I'm not sure how many people have clicked, if any, but are we able to see the results? Oh, look at that. Capital gains tax, 56%. Yeah, I mean, obviously there's been some big rumors about changes in capital gains tax over the past couple of years, really. We'll touch on those in a minute. I don't want to steal anybody's thunder. Inheritance tax, income tax, great. And all of the above, 1/3. So I didn't win the bet. I said most people would pick all of the above. So drinks are on me once we can get to a pub.
I'll take that.
Okay, so let's move on. I'm going to hand over to who is taking this first area?
I think that's me.
That's you. Got a bit lost there, Phil. So over to you.
Thank you. Good afternoon, everyone. I've probably not spoken to many of you, and hopefully I will do in the coming months as I settle in a little bit more at Macalvins. So this webinar is a guide to year-end tax planning. So obviously looking at things like utilising allowances, reliefs, etc. before the 5th of April. But there are a few points contained within the slides which move towards more of a longer term view of tax planning. Obviously, we had the budget last week, and I think, Tarek, if you can go on to the next slide, we've got some of the sort of key immediate changes.
I was a bit delayed, wasn't
I? So yeah, the budget last week, really, I suppose you can split it into two parts. You had the sort of incentives and relaxations and extensions to the current rules that we've got as a result of the pandemic, and the longer term view of the government as to how we're going to plug the gap in terms of the help and resources that we've provided to individuals and businesses over the last year or so. So the 3 points on the screen, you've got the 5% reduced VAT rate for hospitality has been extended until September this year. The rate will increase up to 12.5%, and that will last until April next year, with a return at that point to the normal 20% rate. The stamp duty land tax holiday on property valued up to 500 has been extended for another few months. It was due to expire this month, in March. So we've now got that until the end of June. The nil rate band will then be reduced from 500 to 250 for another few months until the end of September, with it reverting to the normal 125 nil rate as of the 1st of October. So I can imagine there's going to be quite a lot of movement on people looking at sort of purchasing property, moving around, etc. And then the final point on business losses. The usual rule for a business loss is that it can be offset in the current year, carried back a year, or carried forward against future profits. This has been extended so that we now have a 3-year carryback period. So hopefully, the idea being hopefully we'll be able to offset some of the losses that businesses may have occurred during the pandemic against previous periods in which they did make a profit. If there aren't any, it will roll forward in the usual manner. Thinking about the longer term implications of what Mr. Sunak made reference to in the budget in terms of things like corporate tax increasing to a top rate of 25%. These are longer term. You're not going to see them for another couple of years, but I think it's generally accepted that there will be tax rises. That's the one we know of at this point. There will probably be some more as time goes on. And I think with all the rumour and conjecture around CGT, I think that's going to be one that's definitely looked at. I know the poll said that a lot of people are concerned about Cgt Changes. We're having some reform discussions at the moment on both Cgt and IHT. I think most people's perception is Cgt will realign with income tax, meaning a top headline rate of 45%, which could be, extremely detrimental to those who have uncrystallized gains at this point. So it's definitely an area that's under scrutiny, but there are also areas which are ripe for reform. Things like the pensions regime, unfortunately, even though we've had several versions of reform over the last 10 to 15 years, it's still a web of complexity, not really helpful for many, too difficult to understand, and that's been recommended for reform, along with stamp duty, interestingly enough. It's an old tax in many respects, and it's time for an overhaul. So I think in general terms, the tax landscape is definitely going to change in the next 2 to 3, maybe 4 years. And what we have at the moment in terms of the overly complex and slightly antiquated system will be replaced, hopefully, with something a lot more relevant for our times.
I suppose the timing of that obviously will be somewhat linked to general elections and such like as well. So it'll be interesting to see when they change some of these taxes, for example, capital gains tax. I would have thought they would do it sooner rather than later, given elections coming up and such.
Yeah,
like. So,
and also piggybacking off that point, that in the Chancellor did make reference to the tax triple lock that the Conservative manifesto put in place at the last election. That's not going to be touched for the duration of this Parliament. They've made clear on that. So if you're not touching VAT, income tax, and NIC, what areas are there left? There's corporate tax, there's things like stamp duty, and then there's the capital taxes like CGT and IHT. So I think you're right. I think there will be changes in the next 12 to 24 months on CGT, certainly.
Mm.
And whether that be a movement in the rates or stricter guidelines and legislation surrounding claiming of relief, etc. And I've heard some horrible rumours about things like principal private residence exemption being removed or tightened, which would be absolutely catastrophic for the housing market. But interestingly enough, places like the US don't have the same level of complete exemption on main residence disposal. So I think it remains to be seen. We're probably going to have a fair few of these webinars covering certain points over the time. So yeah, watch this space very much.
Good, thanks for that, Phil. I'm going to hand over now to Kaya, who's going to take us through some, obviously with the topic in mind, it's year-end tax planning and address some of the business tax issues.
Thank you, Tariq. Good afternoon, everyone. Thank you for spending your lunchtime hour with us today. First day of the relaxing of the third national lockdown. So thank you. And I'm sure we're all enjoying some normalcy or a break from our part-time roles as teachers. Some of us may have kids, and all of those would relate with me today that it's better to be not having that part-time job anymore. Long may the roadmap continue, and we'll get back to more and more normalcy. But as we get back to more and more normalcy, I think tax will become more and more topical, more and more important. Today's webinar, today's ideas that we have got on the webinar, we're going to touch upon between me, Phil, and Tariq. Really, they're all simple but pragmatic solutions, relevant solutions, practical solutions. None of the aggressive tax planning kind of too good to be true kind of ideas. But as Phil touched upon, the tax landscape has kept on changing, and it's likely to change in another 2 to 3 years. The days of so-called aggressive tax planning, DOTA schemes have all been gone with. So, but we're still left with good pragmatic tax planning, simple tax planning ideas that sometimes look that it should have been looked at quite a long time ago, but people miss out on. And we're going to keep it fluid. I know we've got 2 sections in my presentation between business tax and personal tax, and looking at the list of the attendees and our predominant client base, owner-managed businesses, there's hardly any distinction between business tax and personal tax. You want a level of optimization where both the taxes are looked at in sync, and that's where Macalvins have a suite offering where we not only look at your business taxes when we are doing your personal tax planning, or the other way around. And one of the main points around today's tax planning theme, I think so, is about solid ideas around using and maximizing your allowances and reliefs, statutory reliefs that the government has put in place to either encourage financial behavior in certain way, or allowances are there to make tax more fair and equal. And it spreads across various allowances. And I mean, 15, 20 years ago, you didn't have a raft of such allowances to worry about and plan around. And so it's quite important that you revisit your financial affairs structuring and income generation footprint, where you see that you're maximizing all these allowances. To talk about some, we'll go through the points on the slides as well, but I'm going to keep it very fluid between business taxes and personal taxes. And feel free to interact via the Q&A if anything is of particular concern on the slides as well. But touching upon allowances, I thought what was surprising to an extent to see in our survey at the start, more than 50%, more than half of you have got capital gains tax as the top of your tax concern. At the moment, people would try and use the very low CGT rates, 10%, 18%, or 10%, 20% property or non-property gains, quite low compared to income tax rate of 20%, 40%, 45%, 60%. I'll come to that as well further down. But so I thought personal tax would be more relevant, but I think so all the rumors and talks about the changes to CGT put CGT quite at the forefront. So we'll try and cover CGT in a little bit more depth today if we can. But just starting off with income tax and allowances, the most prominent, of course, is the personal allowance, the £12,500 of personal allowance that is available to all of us. There's a transferable marriage allowance of 1,250. We come across this quite often where clients have not used it. I know it's not massive, but still relevant in the current climate. Personal savings allowance, £1,000 or 500, depending on whether you are a higher rate taxpayer or an additional rate taxpayer, is again something that is not fully utilized many a times, given the low interest rates. But for owner-managed businesses, there are planning opportunities possible from within your business affairs to make sure you can maximize that. I mean, we had it on the previous slides, the tax-free dividend allowance. That's massive, I think. I know it's come down to only £2,000, but are we maximizing that allowance across the family for married couples, kids, or grandparents utilizing the allowances for the grandkids, etc.? We'll touch upon that. Two other small allowances: trading allowance of £1,000, property allowance of £1,000, what we call the gig economy, if you are renting out your garage or doing a small trade on selling some handmade stuff on, not on the high street or Etsy or that kind of platforms. Do speak to us about that as well. One caveat to both the CGT planning, income tax planning, I think, so it's not for today's webinar's subject. There is a raft of anti-avoidance already in place for not being able to divert your income. So the government has thought about this, but within practical situations and circumstances, there are still opportunities where you can legitimately plan and divert income between various family members so that you are maximizing your tax effectiveness as a family. Common themes around married couples: using personal allowance, giving salaries, your income profile, where one person is holding the investment portfolio and all the dividends and the gains are accruing to them. You should consider between moving those allowances equally or in a different fashion, such that at least the allowances are utilized quite well. Something I mentioned there in the passing, which I want to come back on, is the using the allowances of children and grandchildren. Again, we have not put any point on the slides for this, but it's quite important. Sometimes grandparents, parents, relatives have set up trusts, legacy trusts, or can be done as a forward planning now. Trusts and some assets, some income generating assets are settled in those trusts, which could easily distribute income to the relevant children or grandchildren and use their not only personal allowance, dividend allowance, and when you add those two up, a minor child getting up to £14,500 of tax-free income could be quite tax effective for higher rate tax-paying parents or grandparents. It could also be a step in the IHT planning of the grandparents, etc. It could be a very, very welcome aid for parents who are sending kids to private school in this part of the world, in London, or anywhere, in fact, in the UK. So again, caveat it out, it's not straightforward as just putting into a trust, but if a trust already exists, do consider declaring the right level of income distribution from the trusts. And if the income has already been taxed, it could generate tax refunds for the beneficiaries. Something to surely consider. We did mention in the previous slide about business asset disposal relief having come down, and again spreading the shares between various family members, so you maximize the £1 million allowance at the very, very generous 10% tax rate. Again, are you in the right place? And that has to be forward looking, because there are time qualifying holding periods in the business asset disposal relief legislation, or the old entrepreneurs relief, as many of you would still remember or call it. That is also very important to make sure any transfer of shares spreading between the family is done in good time, along with them having to qualify for their lower rate of CGT. We touched upon the savings, personal savings allowance. One thing that is very underutilized, and I know from practical experience speaking to clients, the immediate reaction is, interest rates are where they are. I mean, even with a very sizable savings pot, you're better off taking the lottery with National Savings NSI people rather than leaving it in a bank account. But if you were to lend that money to your own businesses, owner-managed businesses, there's nothing saying unsecured loans to your own business cannot generate 4%, 5%, 6% rate of return to you as the lender to your own business. Yes, it involves probably filing of CT61, deducting tax at source, but which can be reclaimed. But that £1,000, £500 of allowance could be quite efficient way of getting money out of your own businesses, which will be tax deductible for your business as well. Let me move on to the tax that was of most concern, CGT, Capital Gains Tax. Now, capital gains tax sits at about 10%, 20% for non-property assets. And as much as everybody utilizes their personal income tax allowances quite efficiently or reviews it quite regularly, we get a lot more calls from clients and businesses saying, can I do this to utilize the income tax personal allowance of my wife, my husband, my son, etc. We don't get it in the same frequency, questions about utilizing their CGT tax-free allowance, which is more or less at the same level. And when combined as a couple, you have about 25,000, just about £25,000 of tax-free CGT allowance every year, which many times goes unused. And there are ways and means to utilize that as a step up of your base cost of your shares or your portfolio of your investment. So in future, when you come to actual disposal, your base cost is much higher than what your original base cost was, and save tax at the effective CGT rates of the future, which we all worry or think are likely to be much higher. So a 20%, 28% potential savings in the future, or even higher, is there. And what we have a point on the slide which says about inter-spouse transfers. It's not the easiest with the properties unless it's a jointly owned property and things like that via Form 17. But even a property where you own it yourself, if there's no mortgage, things can be done much more relatively simply. When there is mortgage, the assumption of debt creates SDLT issues. I won't go into the details of that for now, for the purpose of this. But the point I wanted to touch upon was the theme of what we call in the tax world of bed and breakfasting. And Phil would correct me if I'm wrong, but the idea was quite a commonplace before Gordon Brown took an issue with this type of planning, and he brought in anti-avoidance to circumvent that. The idea is very simple. You sell your shares on the 5th of April, crystallize your gain up to the tax-free allowance, and then you buy it back again, let's say at the start of the next tax year. So your base cost has gone up, and then in the future when you actually sell it, you don't pay tax on that gain which you have already crystallized. Gordon Brown didn't like it. As I said, the rules are now such that anything done within a 30-day period will be looked back and tied back. So unless you take investment risk, you can't take this bed and breakfasting tax planning further. But actually, there is still sensible, non-aggressive planning available within the very much the same thing, and what I would call bed and something else, i.e. bed and SIP, bed and ISA. So the same technology, if you like, what I just touched upon, but if you were to do the buying and selling with your own personal portfolio versus with your SIP or ISA, and we'll touch upon that because the SIP and ISA are in their own rights tax planning tools that you should look at year end overall. So if you have those vehicles, those wrappers in place, which are already tax efficient, you can play around with them. Bed and spouse, I mean, you could do the selling in your portfolio and purchase it in your spouse or partner's portfolio, keeping the joint investment profile the same, but uplifting the base cost in one portfolio and vice versa. So that kind of bed and breakfasting planning with different other structures, wrappers, is still quite relevant, and rightly so, I think. So why you don't want to do this kind of tax planning right at the start of the tax year is because you may actually need excess or liquidity, and you may liquidate investments for investment reasons, for other reasons, because it's the right time to exit and crystallize genuine gains, which will use up your allowance. So come towards the end of the tax year, now you have a very good visibility of what gains you've already crystallized, what level of your allowance you've not used or your partner is not going to use, and what liquidity you have in your SIP or ISA to do the counter balancing investment. This is the right time. This next 3 weeks is the right time to review your CGT allowance maximization. So do consider that. Some of the other points mentioned there: salary versus benefits. 2 other points I want to cover very quickly. One is additional pension contributions. It's mentioned there. I think so. There's a whole section on that Phil will touch upon later down the line. But it's very, very important for two taxpayers in particular from an income tax perspective. Even if you're not using pension in its own right as a full-blown tax planning tool, is people who will either end up losing child benefit because they start earning more than £50,000 of income, or people, the highest marginal rate taxpayers in the UK, 60% taxpayers as we call them, people earning between £100,000 and £125,000. Now, these are typically, I think, people who are in PAYE jobs, earning relatively good salary, being in a relatively good position in their workplace, earning around £100,000, who may or may not get a bonus. Now, if you're only going to find out about your bonus nearer the end of the tax year, which is not uncommon, for you to do some last-minute tax planning because you are not sure what to do pre last 3 weeks. This pension comes very handy to minimize the marginal rate tax impact when you take high income child benefit charge or the loss of personal allowance into account. The return could be 60%, 65%. Both of these can also be managed via gift aid contributions, which are another tax planning tool, year-end tax planning tool. Don't forget, with gift aid, you can even carry back 1 year your gift aid. And if you're not sure which charities you want to contribute to, you can make general CIF donations and then choose your charities further down the line. So whole host of planning opportunities there, especially for the 60% taxpayers or the 50% or 50,000 earners who are likely to lose their child benefit as part of getting a bonus or an extra salary or whatever, which is pushing them over that threshold. In the business tax section, there were 1 or 2 points that probably I had not touched upon. But for owner-managed businesses, again, making employer pension contributions would be much more sensible because there are NIC savings attached with that. 1 or 2 other points that we have touched upon, and I think so that relates with the budget as well. In the budget, there has been some changes, positive changes around capital allowances. So any spend on plant and machinery or other stuff which qualifies for capital allowances will receive not only 100% allowance, which was generous, but now they've said it will probably qualify for 130% allowance. So the timing of the spend from an year-end perspective is crucial, whether you need to spend it now in March or you spend it in April, if that's where the year-end of the business is. You may need to change the year-end of the business to keep that crystal clear. All those planning opportunities are there. The last one I want to touch upon, which was there in the business tax planning section of our slide, is, and it touches upon both the points about extraction of profits and benefits. Electric cars, I mean, government is trying very hard to change people's behavior by giving tax breaks via employer-funded EVs. EVs, every 4 weeks, you see more and more manufacturers coming up with their own electric vehicle offerings, and that's the future where the government wants to drive the whole section to. At the moment, for the next 3 years, as we know, there are very generous tax reliefs, i.e. the business can get 100% write-off, and the benefit benefiting employee, be it the owner managed director or their key staff members, will pay very, very minimal benefit in kind. So it's a very, very powerful tool. Again, you may want to consider the timing of it. Doing it pre-end of the tax year could be quite a useful way for some businesses who have managed to still be profit generative in these tough times. Do consider electric vehicles when you come to thinking of replacing your next car. I think so. That probably covers all the slides. One point I've missed, but Phil will pick it up: R&D tax credits as part of the overall budget changes and etc. Thank you.
Thanks for that, Kia. Yeah, as you said, no doubt you'll add a few things as we progress. Phil, over to you to talk about inheritance tax.
Okay, so if you can jump forward, that's the one. As we're coming towards the end of the tax year, it's worthwhile just making sure that if you are in a position to help reduce your overall IHT exposure, you should be certainly looking at your annual gift position. So you've got your small gifts of up to £250. They're unlimited in terms of the number of people you can give them to, although it cannot breach the £250 limit before it becomes a different type of gift. So these are designed really to cover things like Christmas presents, birthday presents, etc. The next gifting rule is the annual exempt amount, which is £3,000. So you can make a cash gift of £3,000 per annum to one person, to however many people, over and above the 250 that I already mentioned, and that is an exempt gift straight away. You can also utilize the previous year's allowance if you haven't done so. So in theory, you could gift up to £6,000 per person before the 5th of April, and then on the 6th of April, gift another £3,000, so £9,000 worth of gifts can leave your estate almost immediately, and reduce that IHT burden down. One of the, I guess, lesser known gifts from an IHT perspective is to do with gifts out of regular income. Now, you have to be in a position where you have surplus income in order to do so, and a one-off gift would not qualify. But if you can make regular contributions to children, grandchildren, whoever it may be, for whatever reason, and you can meet the various conditions, such as it's made out of income and not capital, it's a part of your normal expenditure, and you're left with sufficient income to maintain your standard of living, not a defined standard of living, but your actual standard of living. So if you've got expensive tastes, then you need to make sure you've got enough income to cover them. But any gifts that you do make with no upper limit, I'd like to point out, are immediately exempt from IHT going forward. So the typical example we see in practice is somebody who's maybe just reached retirement. They've got a very good pension in place, as well as having numerous investments. Their level of income is more than enough to cover their day-to-day living costs and give them that standard of living that they've become accustomed to. Any surplus that they deem to be not to their requirements, we can look at making a regular gift to whoever it may be they want to gift it to. That's actually quite a powerful gifting tool from an IHT perspective, because it does then prevent that cash that or that income that you haven't gifted accumulating as cash, and obviously being liable to IHT at potentially 40% upon death. You've also got your normal gifts, things like gifts to spouse, which Kaya partly covered in his transfers of assets to spouses. One thing I would say is that just because it's a spousal transfer, don't assume that everything is completely tax-free. In most cases there are, but it depends upon the type of asset and what type of tax we're looking at. Kay alluded to earlier on, stamp duty can be a bit of a fly in the ointment when it comes to gifting between spouses if there is a deemed transfer of consideration, being a mortgage or a loan secured against the property. So just be mindful that you don't trigger any adverse tax consequences that way.
And
Uh,
Phil, sorry
yeah,
to interrupt.
sorry.
Speaking of gifting, we've got an Everton fan, and I would argue Liverpool have gifted them a European slot. So it's all about gifts.
My ex-father-in-law was an Evertonian as well. That didn't go down well.
Well, if I can also just say, just come in a little bit. Sorry to interject your flow there, but I think it's. We were looking at a client last week, and it's difficult to say how valuable that last inheritance tax planning point you touched upon about gift from regular gift from income, excess income, and relatively well-off pensioner. We did a review with them, and they ended up making pension contributions for their 4 grandchildren out of their excess income. Nothing substantial. We're talking about 2,880 per annum per grandchild, but that they have 4 grandchildren, bless them, and they decided to put it into a pension contribution. So not only they're skipping one generation, the second generation also won't get it relatively further down in the line. So the legacy issue is there, which the grandparents were very happy about. They are saving 40, so 4 grandchildren, they're putting about 2,880, so about £12,000 into pension provisions for their grandchildren, because they know that the next generation will not have as good pension provisions as they have been lucky to have. Not only they're saving 40% on that £12,000, they are also getting a 25% bonus from the government because it's going into a pension pot. So it's when you put the numbers together over a 5 to 10 year period, the family is probably saving in excess of £100,000, which looks very simple. You're putting £2,500 for pension for your grandchildren every year from excess income, which you're not going to have, which you're going to add it to your estate and will have an IHT issue anyways. Yeah, but it's such a powerful tool, that regular gift thing.
Yeah, I mean, if
putting into a pension regular gift is very easy to demonstrate. Sorry, Phil.
Yeah, I mean, if you're lucky enough to be on a kind of a final salary pension scheme, or you've put enough contributions away that you have got a high pension combined with other assets, as you get older, we typically find that people don't spend as much. So if you're on a huge pension that's getting paid year on year into your 60s and 70s, you'll easily spend it. Anything beyond that, in practice, it becomes quite difficult for them to spend, because you're not as active as you used to be when you're younger, and that's when the problems can start, because you've got all this surplus income that's just mounting up, and every pound you make, you're effectively sort of putting away 40p for the taxman on IHT. So it is a really useful tool to use at some point. If we just move on to the next two, are really to do with making sure that you've got a will that really meets your needs and covers all the points that you might want it to, and all the direction of assets, etc. First one on charitable and personal gifts. So if you leave at least 10% of your net estate to a charity, you get the beneficial IHT rate of 36% rather than 40%. Doesn't sound a lot, but when you start adding it up, it does make a big difference. And the second one, passing on your pension. I've seen quite a few times where people haven't made sufficient provision within their pensions, and they effectively die when they do, instead of passing over any remaining fund to surviving spouse, and in some cases, next generation down. So it's just key to make sure that you've got all of those bits and pieces covered, and that your will is up to date, and that you are sending your instructions are as you intend them to be. The final point on trusts. Trusts took a bit of a battering about 15 years ago. Very, very tight legislation was introduced, and they fell out of favour in many ways as a tax planning tool. But we are seeing a bit of a resurgence in that area, and they're not just. I think there's a common misconception that they're for the ultra wealthy and the people that have significant sums of money that they can just flitter away into these things. They're actually quite a useful planning tool for people of all sort of wealth categories. The main reason being that if you do have an asset sitting on a large capital gain, that is uncrystallized at that point, you can, with some clever planning, elect to adopt IHT treatment over CGT treatment. And by doing so and utilising your nil rate bands of £325,000 per person, so a married couple has a 650 combined nil rate band, you can in fact put an asset into a trust up to 650 with no immediate tax charge. Run that trust for a short period of time, collapse it. There might be some tax on any increase in value, but if there's no increase in value, or if your asset was say 600,000 and when you come to collapse the trust it's 630, still within your 650 nil rate band combined, there's no taxes on the way out either, and it's a way of passing down an asset from what you hold and potentially is a chargeable or an asset liable to a chargeable gain. And some of those can be quite significant into the hands of children or grandchildren with no tax charge. The only real costs are the admin of the trust and the setup. You'd obviously need, ideally, to take some legal advice in setting up a trust, although it's not a mandatory requirement.
Yeah, we were discussing that earlier on, that it is surprisingly economical as well, really, to get a trust set up.
Yeah, I think there is that sort of preconceived notion, isn't there, that it is something that's only done by sort of landed gentry and people like that, but it's not the case, and they are really useful tools, and we are seeing a lot more use of them.
And of course, with the SDLT relief that's currently available, moving real estate around is residential real estate around is obviously a lot more fluid, with a lot less cost, subject to certain conditions.
Absolutely.
Okay, great. So let's have a little update on pensions and tax and how they can be utilised as well, Phil. Thank you.
Okay, so some of you may know your contribution limit, and you have your lifetime allowance, which is effectively the value of your combined pension benefits. At the moment, it's at just over 1 million. And when I look back earlier on, it's peaked at 1.8 million and dipped as low as 1 million. So as I said earlier, they keep chopping and changing the pensions regime. And as a result, they've made it too complex again. And that's why they're looking at completely overhauling the system, although we don't know in what direction they'll move just at the moment. With a pension scheme, you obviously have, from the age of 55, the ability to take a lump sum of up to 25% of the scheme, which is tax-free. So if you've got something in the region of £1 million, as the lifetime allowance figures show there, you could be getting £250,000 out completely tax-free. One point I would say is that if you don't necessarily need the cash, please be mindful whether or not it's worth extracting it, because once you've got that cash in your hands, that then becomes an asset for IHT purposes. So if you're just adding for the sake of taking the money out, it doesn't always work out more efficient. In a pension scheme, they by and large are IHT free. So if you'd rather reinvest a whole lot into an annuity or draw down as and when you need it, that's probably worth considering, as opposed to just taking the 25%, which I think a lot of people just assume is the automatic thing to do. Kaya touched upon the stakeholder pension point there. It's a really good tool if you've got, if you're in a position that you can make the contributions on behalf of the children. I read somewhere over the weekend that if you start investing something like £8 a day in a pension scheme for a child, by the time they come to hit retirement at 55, they could have a pension pot worth over 2 million based upon current modelling, which seems ludicrous, but I guess it all just stacks up over time. I've just gone over the pension drawdown point. The annual pension allowance is 40,000 if you are not an additional or ultra rate taxpayer. Once you hit certain criteria, which I think is about 200k at the moment, annual income, that starts to whittle down to a minimum allowance of £10,000. However, you do have the ability to use the unused pensions allowance. So, and that goes back 3 years. So in theory, if you're a 40,000, or if you're able to claim £40,000 worth of pension contributions relief each year, You do that for the current year and the previous 3 tax years. In reality, you are able to contribute £160,000 into that pension scheme if you have not done so. So it's worth looking back at previous years as well if you're in a position to make a surplus contribution to see if it's worthwhile. The point regarding employers' pension contributions, Kay has already touched on. They are very efficient. It's a corporate tax deduction or a partnership tax deduction, depending upon what entity status you have. But it's a saving of tax in that respect. It helps the employee by being paid as opposed to coming out of their taxable income and then paying over to their own scheme. So it's a very efficient use of funds, and obviously helps the pension pot grow. Jump to the next slide. I think I'll also, just before we go on, I'll just cover the R&D point that Kaya mentioned earlier. R&D, I think people, similar to trust, there's a bit of a misconception that it is people in white coats in labs, and very kind of scientific based, and that's not necessarily the case. To qualify, you have to be seen to be overcoming some uncertainty and making some advances in a science or technological arena. But it doesn't necessarily have to be, something like a vaccine or biotech or anything like that. It can be a process, a product or service, or an improvement on an existing one. So very often you see instances where there's an existing product, somebody has noticed there's maybe a gap in what it can do, and they've tweaked it slightly, and that's qualified. By the revenue and government's own admission, it's not as widely used as it possibly could be. It's not something I think that they're overly happy with the way that they've looked after it over the last few years. It's a very, very beneficial if you are in a position that you do qualify for R&D. So for every £100 you spend, you get £130 additional deduction. So if you were to spend £100 on qualifying R&D revenue expenditure, in essence, that's a £230 deduction from your business profits. And then it's also, it's a case of either increasing any losses that may occur or surrendering the expenditure or loss incurred for a repayable tax credit from HMRC at 14.5%. So it's an extremely efficient and effective scheme. If you are in any doubt, you can even apply for HMRC's advanced assurance so that you get comfortable and confirmation from HMRC that what you're doing will qualify for R&D, and therefore you can put the claim through the corporate tax return at a later date. And
I would urge anybody that's believe they've got any scope for making a claim for R&D tax credits or relief to get in touch with us, because we actually provide that service on the equivalent of a no win, no fee basis. So it's definitely worth picking up the phone and having a sort of 10-15 minute chat with Phil or Kaya, just to get a sense of, or one of your client directors that you're currently working with, just to get a sense of whether it's whatever you're working on is something that would qualify, because we can help you with that.
Yeah, I mean, I've had clients over the years that have had a wide range of qualifying products or processes, from things to do with mobile phones, software, any kind of science advancement or improvement. So it's really wide ranging. There's also something which we haven't touched upon in the slides, but it's quite closely linked to R&D, and that's land remediation relief, whereby if you basically decontaminate contaminated land and put it into some kind of sort of usable purpose, you can get up to 150% deduction on the expenditure. So I've had clients before who have been looking at things like old petrol forecourts where the petrol tanks are underground, and you've obviously got seepage and potential pollutants. Any expenditure incurred on that could potentially qualify for the land remediation relief. So it's another one that you can kind of bolt on depending on what you're doing and what your business activities are.
Great.
conscious of time, so I'll try and rattle through these as quickly as we can.
You've got a long list to get through there.
Yeah.
Don't make it easy.
Yeah. So in terms of tax efficient investments, if you do have some spare cash, or on a couple of them, which I'll go into, if you've got potentially a capital gain which has crystallized, you can look at making some investments into the following. So you've got the ISAs, which I think most people know about, and depending on where you are in life, if you've got Help to Buy ISA or a lifetime ISA, if you happen to be in that kind of age bracket, or your normal stocks and shares and child ISAs, or junior ISAs as they're known. They're just usual sort of places that you can bung cash and benefit from the tax exempt status. Moving on to share schemes, it's as a business owner, it's something that you can implement to help sort of incentivize and pay the staff whilst not necessarily impacting too much on cash flow. So there's different types of share schemes. We would obviously recommend you have an approved share scheme. So one of the ones that HMRC are happy with, something like a company share option plan, employee management incentive, SIPs, or save as you earn, something along those lines, which people would be happy to maybe forego a bonus, say, and get a piece of the pie, as the saying goes. You can even go one step further and set up things like employee benefit trusts or employee ownership trusts, if that's something that is something of interest to you. That in itself is a webinar on its own, and possibly a long one, so I won't delve too much into that. But there are tax efficient ways of sort of allowing key employees to get involved in the business. EIS and SEIS, we obviously had the webinar that didn't happen, but they are sort of high risk, high reward areas that you can either invest and get the tax reducer, or you can even defer capital gains and invest in sort of startup or high growth companies, covered with some very beneficial tax reliefs, some ranging from about 30% income tax reducers right the way up to 50% on SEIS. So if you do have a gain and you're thinking before the end of the year that you might want to crystallize it, but you don't necessarily want to pay the tax, and there are a few potential growth companies that you might invest in, that's a great way of mitigating the tax liability on that. On the right hand side, you've got some lesser known, I think is the best way of describing them, types of investments. A venture capital trust investment is similar to EIS and SEIS. You get a tax reducer and you can have some beneficial treatments on dividends. Community investments, social enterprise investments, it's really trying to get people to put back and help build communities, and really, they're not quite as beneficial as things like EIS and SEIS, simply because of the risk involved with those. But community and social investments, you do get some decent tax breaks there. And then the last two, the life insurance bonds and the offshore bonds, it's a good way of encapsulating some funds that you may have. And there's some nice tax-free withdrawals in terms of you can put an amount in and you can draw up to 5% of the bond tax-free typically per year. So that's a very kind of whistle-stop tour of some tax-efficient investments. As Tarek said, if you have any queries on any of them, please feel free to sort of reach out to us and get in contact. I'm happy to run through them.
Tarek, I know we're running very, very close to the time here, but very quickly, one point there, Phil. I feel very passionate about lifetime ISAs, and I just wanted to mention it very quickly for a minute there. Unlike other ISAs, where you have the tax-free wrapper on the returns, i.e. the growth or the dividends, lifetime ISA is the only one where on the way in as well, you have a tax incentive. So you put in the maximum £4,000, government gives you another 25% top up of £1,000. Now, the earliest you can do this is for 18-year-olds. So if you think you are not in the age group where you can open the ISA, you're probably in the age group where you can do this for your kids or your grandkids who are 18. Now, 18 to 35, if they maximize their allowances, you can get £32,000 of free top-ups from the government per child or per grandchild. Now, that's massive. But yeah, sorry, I know we can talk a lot more around that, but I just wanted to mention that.
Thank you. I don't think I qualify.
Me neither, sadly.
Thanks everybody. Thanks, Kay and Phil. We really right on the edge. We've got a couple of minutes to go. Obviously, we won't have covered. We've covered a lot, but we haven't covered everything, and there will be some. There will be some of what we've covered that will benefit you, but maybe there's some other areas that we could address offline. We don't have enough time for questions now. We've got a quick poll though that we wanted to put up on the screen, so just give us an indication on whether you need us to get in touch with you, and sort of, you know, on a complimentary basis, happy to pick up the phone for sort of 15-20 minutes and run through a few areas that might be of concern and interest. Clearly, we had over 50% of you tick the box to say capital gains tax was one of your biggest areas of concern. There's a big positive of that, of course. It means you're all have made, you know, good investments, which I hope will continue. So I think we've given everybody, maybe give them another couple of seconds, and then we'll get the results of that poll up on the screen. Do let us know separately though. An email is going to come out later today asking you for some feedback on today's webinar. Be great if you can give us some feedback. Also indicate any particular areas which you would like us to cover off on future webinars. I mean, tax people obviously like to talk a lot about tax. You may love to talk about audit, for example. I'm not quite sure how entertaining that would be, but we've got, you know, obviously we've got a healthy audit team, and I'm sure Colin would love to talk about audit at some point in the future. But in all seriousness, you know, if there's any topics of particular interest, do reach out to us via that feedback form. Well, that's great. So many thanks again, everybody, for joining, and look forward to seeing you again soon. Thank you, Kaya. Thank you, Phil. And great. Have a good afternoon.
Pleasure. Thank you.
Very much.
Bye, everyone.
Bye.